Hey man, I'm doing well. I appreciate this because I get lost sometimes just talking about the daily stuff in my show. So doing a weekly show for you allows me to kind of wrap up my thoughts for the week. So thank you for the opportunity.
Oh yeah. I mean, the first thing I want to talk about is Elon Musk buying 9% of shares in Twitter. Did you
Yeah,
talk about that at all this week?
I did. I mentioned it the day it came out. He spent I forget what it was, 2.8 billion or something number. Very impressive. Elon Musk sold all those Tesla shares. He is now using it to make a difference. You know, Elon Musk is an interesting cat because he was able to do a lot with very little. Now he's
Hmm.
got billions of dollars. That cat's gonna do some crazy stuff. So, it's gonna be fun to watch.
I was I hear I was listening to a podcast. So like, what's the point of having fuck you money if you don't do fuck you things?
Yeah, exactly. Oh, Elon is gonna be fun to watch. And he thought again, right? So I don't know if you folks know this, but he's on the radar of the SEC, right?
Oh yeah.
He got a little trouble for talking about I think Tesla like at 420 and some tweets he put out. Not cool, right? Kind of misleading. These were years ago. But the SEC is paying attention. So if you're watching his Twitter feed, about 3 weeks ago, he left breadcrumbs that he was going to do something with Twitter. He started asking questions like, should you do this? Should you do that? Should you do this? And if you were watching his breadcrumbs and had experience, you knew what was coming. So some people bought ahead, and the SEC is now looking into this going, come on, Elon, what are you're acquiring the stock. You're telling everybody you're doing it. And, now they're not happy. So he's flipping the finger to the SEC again,
Again.
again.
Again. He's I think he's my favorite celebrity entrepreneur. Yeah.
I don't even think it's close. I mean, let me be very clear. I'm not an Elon Musk fan. Just I don't really jive with him, but I do respect the fact that he is willing to just do it. So I respect that. I don't really gel or vibe with him, but yeah, he's got FU money and he's using it. So it's entertaining to watch.
Well, so he put in, I think it was $2 to $3 billion, and then he made $1 billion off of when the news came out.
Yeah,
He made
he
a
made a
billion.
billion. He made $1 billion. Yeah, that's moving markets, folks. And the SEC is not going to like that.
Not at all.
Not at all.
So what does it take to do a hostile takeover of a company? Like if you wanted to and you're a random rich dude,
Hmm. Typically,
is it 9% to 10% is like minimum?
well, you typically have to become the largest shareholder. So I don't. I believe Jack Dorsey at Twitter is still the largest shareholder. I believe Jack Dorsey owns over 50%. I don't believe he let that much go. So
Okay.
in Twitter's case, let's just talk generically speaking. Once you become the largest shareholder, you now can swing the market. You can now swing activities. Some closely held, like Tesla, for example. Elon Musk is still the largest owner of Tesla. No matter what happens, you cannot accumulate enough shares because he kept it right in his reigns. But yeah, if you become the largest shareholder, that's the thing. And then if you break 10%, you actually that's another factor. So yeah.
I mean, I like it. Like I've read like Donald Trump hostily tried to take over a couple different companies on the stock market,
Mhm.
and like a couple different. It's not an uncommon thing.
No, it actually I think we're going to head back to those situations. There's the thing in the 80s that was really sparked by I forget what the debt was called, but basically there was a bunch of debt being created that was high risk debt, and there was this thing called greenmail, which isn't really called blackmail. Basically, you buy a bunch of shares, you get bought out for higher prices. Then there was leveraged takeovers like RJI and Nabisco, the largest takeover at the time. It's going to come around, right? Businesses were bloated, and now there's a lot of value there. So hostile takeovers are coming back. Carl Icahn was one of the largest hostile takeovers. It's very common. Was very common in great environments where stocks keep going up. It's not very common. You just get paid off
Okay.
with rising stocks.
Yeah.
But as the market goes down, hostile takeovers are pretty common, and I think that era is coming back.
Okay. So let's now go into that was what I thought was the best news of the week. What
It
are
was
other
awesome.
big things that happened this week in the
Well,
financial markets?
I think there's a lot of things that you need to be paying attention to. So first and foremost, our game of real estate. The 30-year mortgage for owner ox broke 5%. As somebody who's been doing this for nearly 20 some odd years, 5% is still great money. But for anybody doing it the last 2 or 3 years who are used to 2 or 3% money, 5% is a game changer. It's going to change buying behaviors. We're going to buyer demand destruction. The market's going to slow down. It's what the Fed does. We also have the Fed coming out being uber aggressive. They're going to jack rates up 50 basis points and 50 basis points again in June. There's a lot of people out there that don't believe it, frankly, and they're going to buy the dip. If they're right, they're going to make a ton of money. I think they're going to be wrong and get smoked. I think the Fed always had 2 mandates. They forgot one of them for the last 2 years because of the pandemic. Now they are behind the curve and they know it. And they're going to jack rates up pretty quick. So we've already seen that in the bond market. The stock market's not behaving, right? The bond market's just a train wreck, a bloodbath. But the stock market's down like 8-12%. We're going to find out in a couple months if we really have a bear market. And again, I invested through the last bear market where the NASDAQ was down 80%. So the NASDAQ being down, whatever it is, 12% or something, that's nothing compared to what could happen.
So what are the 2 things the Fed is supposed to do?
They have 2 mandates. The Federal Reserve has
mandates.
2 mandates. They are supposed to have stable prices, inflation below 2%, and full employment. Full employment's definition has changed. When I was getting my degree, it was 6%. It was lowered to 5%. Today we're at 3.6, right? Congrats, Fed. You've got full employment. Now get out of the way and deal with prices because they're 7.9. Next week we have CPI coming out on Tuesday. It's going to be in the 8s. It's going to be just horrible, man. The average family is spending an extra $2,000 a year on and getting nothing for it because it's higher gas, higher food, higher rent. Man, people are getting really hurt. And I think the Fed finally understands.
That's wild. Okay. So we got that. What next?
The consumer. Again, something I've studied for 30 years as a consumer. Somebody who studied economics and has an econ degree, you always have to pick your thing.
Mm-hmm.
And my thing is the consumer, right? The consumer is, most people know, are 68% of the U.S. economy. What you may not know is 75% of that consumption is done by only 25% of the consumers. So inside the consumer, 68%, 25% of the population has a household income over 100 grand. So 1 in 4. And it's that 1 in 4 that makes up 75% of spending, right? Because it makes sense, right? You got to have extra money so you can buy stuff.
Yep.
And those consumers, based on a survey done by CNBC and I don't know, somebody else, I forget the name, are now saying they're getting nervous. So it's very interesting times. And I think consumers are retreating. They're going to buy less cars. They're going to take less trips. They're going out to eat less. How scared do you have to be to go out to eat less? Wild.
I mean, the gas, bro, I filled up my Ford Fusion yesterday. Like, I don't drive a nice car or anything. It was $90.
Yeah, I drive a nice whip, and it was like $130
for that Mercedes.
Yeah.
Wow.
And I mean, that's just crazy for me. I mean, yeah, it's crazy.
Well, I still to this day don't know how people can live off of less than $100,000 a year.
Yeah, it's
like especially in the Bay Area, like you are bunking up.
Yeah, for sure. You got 5 roommates. Yeah.
Yeah. You have 5 roommates. LA. I'm surprised there hasn't been more of an exodus out of California. Because the only reason you would stay because of family, but then you're staying to be with family, but you're all living together.
Yeah,
I guess it's just a different cultural vibe though, right?
Yeah, I think well, California's had 2 years of negative migration. First 2 years in my entire life, right? California's the spot. Most importantly, we have lost the next generation because what made the Valley, and I'm sure it's the same for LA, is we always had those college graduates and engineers and computer scientists coming.
Yep.
They've stopped coming. They've gone to Tennessee. They've gone to Austin. They've gone to Miami. And that's going to be a huge problem because those are the people that got to the startups that made something that bought this stupid housing, right? I live in an area where the average price like Palo Alto is like 1.8 million and it's a nothing house.
Yeah.
5, 6, 10 years from now, when that next generation's not here, it's still going to be a know nothing house, but it won't be 1.8 million. It'll be something lower. It's going to be a problem.
I mean, think about all of the people in the Silicon Valley going to Miami.
Dude,
All the businesses too. Miami and Austin. And Salt Lake as well.
Miami's going to be the spot. It's got the right, it's red. I mean, this is business friendly. It's got the right tax vibe, no state taxes. Property taxes are not quite as egregious as Texas. Texas has some
Yep.
pretty egregious
they're
property
bad.
tax.
They're
Bad.
bad in Texas.
Bad.
Like they're significantly bad.
Yeah, every year resets, all that stuff. Yeah, I think if I was starting over again and was single, I might go plant my flag in Florida.
All right. What's the next one? So we got the bond market's freaking out.
Mm-hmm. Yeah, but
Elon Musk.
Bond market. See, that's the other thing that people don't realize, right? A lot of people that are new to the game of money, they look at the stock market like the stock market is the economy. That is just not true. It might feel like that.
Too fast.
Well, it moves too fast, and I mean, would it shock you to realize, like people your age, right? You're younger than me. You probably think the stock market is bigger than the bond market, and bond market is only for those old farts who, don't take
legitimately.
risk, right?
Yeah.
The bond market dwarfs the stock market, like 100 to 1, dwarfs it.
I had no idea.
Yeah, dwarfs it, and it is not an exaggeration to say that the smart money lives in the bond market. The stock market is the hot money, the fast money. The smart money is in the bond market, and the bond market is screaming problems ahead. The 10-year note today went above 2.7. The stock market is farted. It's had a nothing drop. The bond market is screaming problems ahead, and the stock market is like, we are still partying. Right now, what is happening is, if you're at a party and it's New Year's Eve, the smart money is left. The dumb money, the hot money, is partying, loading up the drinks, taking drugs, and the freaking cops are circling the building. If you're still in it when it gets raided, you're going to get got. So yeah, the bond market's where the smart money is, and right now the bond market is screaming problems ahead.
And so, the reason I think bonds are boring, you're only getting a 3 to 5% return with bonds, right?
Yes, it's a guaranteed return.
Is it guaranteed though?
Yeah, of course it is. Well, I mean, it's as guaranteed as anything could be. It's It's a risk-free asset. It is what all other risk assets are compared to. Yes, the 10-year Treasury, yes, is considered
because you can buy bonds from cities and stuff, right?
Oh, you can. So when I'm talking bonds, I'm talking Treasuries, 10-year. That's if you're going to go up the capital stack, things get riskier. Yeah, okay. You could buy debt in Russia right now if you wanted for 98 cents off.
Yeah.
You could if you wanted.
It's probably, I think it's a solid move.
Well,
I think it's a solid move. It could go up eventually. It's a long play.
It is an option. And if you are at a place where you want to play the option market, go nuts. Most people aren't. Most people can't play there.
Bro, I had no idea that the bond market was that big.
Oh, it dwarfs it. Dwarfs the stock market.
And so you think, well, all the smart money's moved into bonds. The bond market's freaking out, and everybody. So what does everybody do? Everybody getting more liquid? What's going on?
Exactly. The smart money is getting liquid, raising dry powder, while the dumb money, the hot money, the buy the dip crowd is still partying like it's 1999. And you guys haven't looked out the window yet, and there's cops around the building ready to come in.
And then they're just not going to be able to buy the dip because the other people are really preparing to buy the dip.
Yeah. So here's the deal, right? So Jamie Dimon, arguably, and Warren Buffett, right? Two of arguably the top 10 investors in the world, arguably. Certainly in the top 100. Both of them have been raising cash, like cash. We're not talking bonds. We're talking cold, hard currency, dollars, for about a year now. They're not idiots. They both know that inflation is running at 10%. They both know by keeping cash in the bank that they're losing 10%. The only reason they're doing that is because they're going to buy the dip hard. like 40% off.
Yeah, and they'll gain the 30.
While all the people that are buy the dip crowds are going to be out of money. The dip bought the dip. You've all seen the memes with the people standing behind. Warren Buffett and Jamie Dimon are in the balcony with the sniper rifle, ready to take out the last one. If you're throwing all your last bit of capital in right now, you're going to get got.
So you think everybody's buying at the top?
Well, clearly it's not the top, but there's a lot more room below.
Top-ish. Yeah, top-ish.
There's a trap door. That's what the bond market is saying.
I like that. That was a good educational one. What other big things happened?
I'm excited by what's coming, right? One of the things as a real estate investor I love is finding motivated sellers. The hardest thing to find the last 2 years was a motivated seller because all you had to do was put a sign in the yard and you got above asking. That's hard, right? The only things we bought 12 or 13 deals over 2 years, all off market. I am so excited to start writing offers on MLS-based deals because buyers are going to run away. I'm going to be able to write offers on great deals below asking. And yeah, a lot of them are going to tell me to F off. It's okay. I'll just write a new one. I'm going to start getting counters. I'm going to start buying great deals on the MLS. Right when everybody else runs away scared, when people are running away scared, I'm running in. When people are running in, I'm running out. The last 2 years, I ran out. I sold apartment buildings in 19 before the pandemic because they were stupid priced. I was wrong because of a pandemic. If we don't have it, I was right. And right now, dude,
Yeah.
I've got dry powder. I'm ready to go in. I'm excited. I'm almost vibrating with excitement about what's coming.
I still think you could start a significantly sized fund and have a good time.
Oh, I certainly could. There's no question.
I think like when the time comes, start a fund and then you have as much capital as you'd really need to go start swooping up a lot, competing with the hedge funds.
I could.
All right.
Yeah.
Okay, here's a topic I was talking to my friend Jennings about yesterday on my podcast,
Uh-huh.
to where everybody's selling these properties to hedge funds.
Mm-hmm.
And the reason, so like hedge funds own like 50% of the property now, or something crazy.
That's not true, but they own more than they used to. But go ahead.
Own more than they used to where I do see the hedge funds truly pushing into owning the majority of it and people not being able to own real estate. Yes,
Well-
you'll eventually find a new asset class, but like I
Yeah.
don't like no
Yes.
one body should own 30% of anything.
Well, we live in a capitalist system, so yeah. So first and foremost, so I guess a couple of things. So one of the things I did in my career is I traveled the world, right? It was I hated travel. Anyways, I traveled the world. And I have been to countries where insurance companies own 80+% of real estate. 80%.
That's insane.
Right? 80%. It's not uncommon in Europe, right? Europe, it happens. And today in the United States, Wall Street, whatever, owns about 1%, arguably maybe 1.5%. Wall Street. If you add in big investors like myself, you get up to about 8 or 9%, right? Even last quarter, which was a record quarter for investors, we bought 18%, which means 82% were bought by owner occupants. These people that are saying the hedge funds are going to come and dominate U.S. real estate are misinformed. Could it lead that way? Sure. Could there be some cities, like there are some cities they dominate? Phoenix, Arizona.
It doesn't make any sense. It's because it's still like a high priced market, but they can still buy in it. Like it's crazy.
Well,
Like
here's
we don't
the
have
deal.
hedge funds in California.
No, it's because of
We have Wedgwood, and that's all.
Yeah, here's the deal. Why were they so big in these other markets? It's because of the fucking Federal Reserve. The Federal Reserve made the cost of risk zero.
Yeah.
So why were they buying? They were buying simply because they can get a risk-adjusted return of 6. They were buying all they could at a 6%. They will pay whatever they can as long as they get a 6%. And oh, by the way, rents have gone up the last year, so they could pay more.
Yeah.
But guess what? The bond market is screaming problems ahead. The 10-year treasury was sub 1% like a year ago. It is now 2.7 and going higher. Hedge funds will pull themselves out. Why buy a house if you can get 4% in a 10-year treasury?
Yeah.
It was just the best return. Now, when Wall Street can go do buyouts. They can go they'll go somewhere else. Wall Street is a simple creature. They go where the best return is. And for 2 years, the Federal Reserve made the single family home the best return.
The best. Okay.
And very soon it's not going to be the best return and they will go somewhere else.
Well, you just proved my whole thing. I ain't got nothing else to say, Mike. That was a good one.
I'm sorry.
That was a good one. You got anything else, man?
No, I would tell investors, even though the economy is getting dour, it's getting sour, there's going to be blood in the street. This is the time investors get ready. This is the time investors get rich. So do the work, do the work, do the work. I'm excited.
Awesome. Thank you so much for coming on, Mike. Where can people find out more about you?
One rental at a time. Go to your Google search bar. You should see a website, YouTube channel, books, courses, Instagram. It's all a good time.
Awesome. Thank you so much for coming on, Mike.